Hello, this is Brandon Christy, President of Retirement Benefits Institute. Well, it's important to understand that a Roth, like a traditional TSP or individual retirement account, IRA, is not itself an investment, but rather a tax wrapper or a bucket to hold different investments of your choosing. Inside this wrapper, you may have stocks, bonds, mutual funds, annuities, real estate, so on. Federal employees typically have two kinds of Roth accounts available to them, the Roth TSP and the Roth IRA. Today, let's discuss two real reasons to think Roth. Well, in 2012, the Roth feature was rolled out to the TSP world. This feature allows federal employees to contribute to a traditional TSP, a Roth TSP, or both. Funds contributed to the Roth account are made after tax, meaning federal employees pay income tax before the money goes into the retirement account. This is referred to as a Tax Me Now savings account. Federal employees pay the taxes up front when they make contributions and do not have to pay tax on any distributions as long as certain qualifications are met. Contributing to the Roth TSP is easy, and the option to do so is open to all federal employees. There are no income limits for participation in a Roth TSP like there are with a Roth IRA. The contribution limit for Roth TSP is the same as other 401ks. This year, federal employees in 2020 may contribute up to $19,000 or $25,000 if age 50 or older. The federal employees may choose to put a portion of their funds in Roth and a portion in traditional, or any other combination they choose, but the contribution limit applies to the total of all contributions going into the TSP. So why Roth? Let's look at two real reasons to think Roth. Number one, distributions taken from a traditional account are considered taxable income and therefore could increase your tax bracket. By taking distributions from a Roth account, as long as certain qualifications are met, the federal employees may take distributions that may not increase their tax bracket. Number two, Roth distributions, because they are not taxable income, do not affect any tax deductions that are dependent or affected by your taxable income. To illustrate the two real reasons to think Roth, I'm about to go through two hypothetical examples that show how this may affect some federal employees. So let's talk tax brackets. Bob is 62 and retired. He receives Social Security of $25,000 per year. Mary, a federal employee, is 57 and will soon retire. She'll receive an annuity of $50,000 per year. She also has $250,000 in her TSP. They'll draw $30,000 a year from Mary's TSP. In retirement, they estimate their taxable income will be $77,000, maxing out the 12% federal income tax bracket. See the blue arrow on the graph on your screen. In the event of Bob's death, Mary will still draw her $50,000 annuity and $30,000 a year from her TSP, creating an estimated taxable income after deductions of $68,000, assuming she does not draw Bob's Social Security survivor benefit. Since she is now filing single, all taxable income over $38,000 will be taxed at the 22% federal base, which is 10% more than what they had married. In this situation, Mary would be paying a higher marginal tax rate on IRA or TSP withdrawals as a widow. Mary could consider using a Roth IRA or Roth TSP to hold a portion of her retirement funds. If Bob predeceases her, such a move may allow her greater flexibility to avoid paying additional taxes in the future. The second example, unexpected expenses. So Beth retired from federal service 5 years ago. She and her husband Jeff have been enjoying retirement until a major medical event occurred this year. They had to draw $20,000 extra from their IRAs to cover the expense. This withdrawal was added to their adjusted gross income on their tax return. When they file their return, they will only get to deduct the amount of medical expenses as it relates to the the standard deduction and how all those calculations can get them potentially to an itemized deduction. Well, because of the taxable withdrawals from their IRAs, they lose the ability to deduct money from their taxable income. Had they withdrawn the funds from a non-taxable source, such as a Roth account, their adjusted gross income would not have increased, and they may have been able to take more of the medical deduction on their tax return. So now we've looked at two real reasons to think Roth, as is shown in the lives of Bob, Mary, Beth, and Jeff. Whether they draw from a Roth account or a traditional account does affect their taxable income and thus potentially their tax bracket and or their tax deductions. There's many other things to consider that I did not cover here as you go into retirement and you have your federal pension and your Social Security and your TSP and IRA withdrawals. Such things as additional cost for Medicare Part B. They can charge you more if your income is higher. Several other elements. Make sure that you know why you are putting money into the traditional TSP or the Roth TSP. Plan ahead, not just for the day of retirement, but for the decades you will enjoy in retirement. Well, this is Brandon Christy with Retirement Benefits Institute. Please click Get Help, and we'll be glad to go further with your planning as you get ready to have a successful federal retirement.